Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Intuitive Surgical, Inc. annual report. Intuitive Surgical, Inc. offers a range of innovative medical solutions to enhance the quality of and access to minimally invasive care worldwide. The company's flagship product is the Da Vinci Surgical System, which enables surgeons to perform complex procedures with precision and accuracy using a minimally invasive approach. In addition to its surgical systems, Intuitive Surgical provides various services and products that support the use of its technology. These include stapling, energy, and core instrumentation for multi-port Da Vinci systems, as well as progressive learning pathways to help healthcare providers master the use of its equipment. The company also offers a suite of customer service and support solutions, including installation, repair, maintenance, 24/7 technical support, and proactive system health monitoring. This comprehensive approach ensures that customers receive timely assistance and optimal performance from their Intuitive Surgical systems. Furthermore, Intuitive Surgical provides integrated digital capabilities that enable connected offerings and streamline performance for hospitals. These insights-enhancing programs provide valuable data and analytics to help healthcare providers optimize their use of the Da Vinci Surgical System and other products. In terms of sales, Intuitive Surgical sells its products through direct sales organizations, including capital and clinical sales teams. This approach allows the company to build strong relationships with customers and provide personalized support throughout the purchasing process. Overall, Intuitive Surgical's diverse range of products and services has established it as a leader in the field of minimally invasive care. By providing innovative solutions and comprehensive support, the company is helping to improve patient outcomes and enhance the quality of healthcare worldwide. Intuitive Surgical Inc.'s stock price has dropped by over -18.96% in the past year due to concerns about slowing growth projections and the impact of tariffs. One key factor contributing to this decline is the company's tempered outlook for 2026. In January 2026, Intuitive Surgical released preliminary fourth quarter 2025 results that showed a slowdown in worldwide Da Vinci procedure growth from 18% in 2025 to between 30–15% in 2026. This deceleration in procedure growth is crucial as it directly affects the sales of instruments and accessories, a significant portion of the company's recurring revenue. Another factor contributing to the decline is the impact of tariffs on the company's revenue. In September 2025, Intuitive Surgical raised concerns about the potential impact of tariffs during an investor event, indicating that tariff headwinds for 2026 could exceed its previous projection of a 100 basis point impact on revenue for Q1 2025. The combination of these two factors has led to a decline in investor confidence and a subsequent drop in stock price. As a result, Intuitive Surgical's stock fell by 5.8% and 6% in pre-market trading following the release of its tempered outlook for 2026. Intuitive Surgical, Inc. market capitalization of $172 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Intuitive Surgical, Inc. holds a significant advantage in their industry. Intuitive Surgical, Inc. trades at a higher price-to-earnings ratio of 61 times and a higher price-to-book ratio of 9.47 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The balance sheet appears very conservative, with liabilities representing only 12% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline for Intuitive Surgical can be attributed to several key factors. One significant driver is system sales, which saw a 40.6% decline in sales-type lease revenue from 2024 to 2025. On the other hand, operating lease revenue increased by 33.6% during the same period, indicating a shift towards leasing products rather than outright purchases. Another crucial factor influencing revenue growth or decline is foreign exchange rate fluctuations. The strengthening of the US dollar against non-US currencies resulted in a potential decrease in revenue by $140 million. This highlights the importance of currency exchange rates on international sales and revenue. In addition to these factors, changes in customer demand and acceptance of products also play a significant role in driving revenue growth or decline. As customers increasingly adopt Intuitive Surgical's products, such as Da Vinci surgical systems, revenue is likely to increase. Conversely, if there is a decrease in demand due to various reasons, revenue may decline. Overall, the company's financial performance is influenced by a combination of historical returns, current economic trends, and market conditions. Understanding these factors is essential for investors and stakeholders to make informed decisions about Intuitive Surgical's future prospects. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 23% from 2023 to 2024 due to various challenges such as manufacturing problems, delays in production, intense competition, customer acceptance issues, credit risk, and unfavorable macroeconomic conditions. However, the net income rebounded in 2025, increasing by 18.7% compared to 2024, primarily driven by higher revenue from operating lease arrangements. The profit margins also experienced a decline between 2024 and 2025, decreasing from 67.6% to 65.9%. This reduction of 2.1 percentage points was attributed to several factors, including the imposition of new tariffs, incremental fixed overhead costs, and increased expenses associated with the Da Vinci 5 surgical system. The volatility in usage-based operating lease arrangements also had a significant impact on gross profit margins. The changes in net income and profit margins can be attributed to a combination of internal and external factors. Manufacturing problems, delays, competition, customer acceptance issues, credit risk, macroeconomic conditions, tariffs, trade policies, and increased costs associated with the Da Vinci 5 surgical system all contributed to these fluctuations. The company's financial performance is a testament to its ability to generate positive operating cash flow. Over the past 3 years, the net cash provided by operating activities has consistently increased, indicating a growing trend in the company's profitability. In 2025, the company generated $3,030.5 million in net cash from operating activities, a significant increase from the previous year. This upward trajectory is also evident in 2024, where the company reported $2,415 million in net cash provided by operating activities. Even in 2023, despite being the lowest among the 3 years, the company still managed to generate $1,813.8 million in net cash from operating activities. This steady growth in operating cash flow is a positive indicator of the company's financial health and its ability to sustain itself over time. It suggests that the company is generating sufficient profits to cover its expenses and invest in future growth initiatives. The company's debt level has undergone significant fluctuations in recent years. Initially, the debt level increased by a substantial plus 14.3% from 2024 to 2025, indicating a notable rise in liabilities. However, this trend was short-lived as the debt level subsequently decreased. In terms of interest expenses, there have been notable increases. The company incurred an additional $63 million in interest expenses in 2025 due to tariffs and trade measures. Furthermore, interest expenses rose from $445.3 million in 2024 to $614.7 million in 2025, representing a significant increase. Although the interest expense on page 107 appears to have decreased, this is attributed to gross unrealized losses rather than an actual reduction in interest payments. Management is optimistic about the company's outlook, citing strong revenue growth in 2025 driven by higher sales across various product categories. The primary objective remains to preserve principal while supporting liquidity requirements, with a focus on funding capital investments through cash generated from operations. The company expects procedure growth to drive system demand, particularly in international markets where significant investments are being made. However, management acknowledges challenges such as tariffs, trade barriers, and macroeconomic headwinds that may impact future results. To mitigate these risks, the company is investing in infrastructure to scale and supply customers with highly differentiated products. This includes construction of facilities to expand manufacturing and commercial capabilities. Management also believes they have sufficient liquidity to meet their requirements for the foreseeable future, despite potential reduced cash flow from operations due to external factors. Overall, management's strategy focuses on balancing growth with risk management, ensuring that the company remains financially stable while pursuing opportunities in key markets. The company has made significant moves in its financial dealings through acquisitions and divestitures. One notable instance is the acquisition of intellectual property, which was mentioned on page 116 as a strategic move to enhance the company's assets. In addition to acquiring new assets, the company has also engaged in divestitures, or the disposal of existing ones. A specific example of this can be seen on page 81, where it is reported that the company disposed of property, plant, and equipment, resulting in losses totaling $615 million. The company has been actively engaged in share buybacks over the past year. According to the financial reports, 463,190 shares were repurchased in the quarter ended December 31, 2025. This is not an isolated incident, as a larger-scale share buyback program was also initiated, where the company repurchased 4,800,000 shares at an average price per share of $477.84 and a total value of $2,300,900,000. These transactions indicate that the company has been using its resources to purchase back its own shares from the market, rather than distributing dividends to its shareholders. Concerns about inventory buildup and supply chain disruption are prevalent throughout the report. Inventory buildup is a concern due to increased purchases and commitments, which may lead to stockpiling of goods. The estimated purchase commitments as of December 31, 2025, amount to $2.53 billion, which includes facilities-related purchases that could contribute to inventory buildup. Supply chain disruption concerns are also widespread. Products manufactured outside the U.S. are subject to U.S. customs and FDA inspection upon entry into the U.S., which may lead to shortages and delays. Tariffs, trade barriers, and regulatory requirements can impact the ability to manufacture and sell products, leading to potential significant increases in costs due to supply chain disruptions. Furthermore, component supply shortages, import or export restrictions on components, materials, or technology, and difficulty transferring production lines to new facilities may cause supply chain disruptions. The report also highlights concerns about supply chain disruption due to ongoing and future global conflicts, public health crises, natural disasters, extreme weather conditions, power outages, water scarcity, regulatory requirements, and consolidation in the healthcare industry. In addition, uncertainty around sourcing conflict minerals from Democratic Republic of the Congo or adjoining regions may affect the ability to obtain manufactured materials at favorable terms or consistent sources. Tariffs and trade measures have already increased cost of revenues by $63 million in 2025, and supply chain challenges may lead to tariff-related inflation in raw materials costs and supply shortages. Overall, the report emphasizes the need for careful management of inventory buildup and supply chain disruption risks to ensure business continuity and mitigate potential losses. That concludes the financial summary for Intuitive Surgical, Inc. Feel free to comment below, and I will be happy to answer them when possible.